Right friends, welcome back to Banking Awareness lecture. This is module number 10, very important because we are going to introduce several new words in this lecture, and we are going to see the difference between cash credit and overdraft account. What is the difference between EMI and amortization, moratorium and servicing of loan, difference between lessor and lessee, bailer and bailee, and the difference between pledge, mortgage and hypothecation. These words are very important in banking parlance, and let us look at the difference between cash credit account and overdraft account. What is the difference between cash credit and overdraft? Before going into cash credit and overdraft, I would like to tell you once again, normally we know about various types of loans like personal loan, house loan, mortgage loan, vehicle loan, and these loans are sanctioned and given by the bank at once. The loan amount will be transferred to your account at once, right? And you start paying back every month, except agriculture loans. Agriculture loans normally not serviced every month, but all other loans like vehicle loans, mortgage loans, house loans, they are serviced every month. That means borrower has to pay back to the lender every month. So vehicle loans, mortgage loans, house loans, personal loans, these are all one particular category where the amount is given at once and you have to pay back every month. But cash credit account and overdraft account are different category. Cash credit and overdraft is bank will give the fixed limit. Bank will give the limit, and subject to the limit, whenever you want, you can take the loan. Suppose, let us assume bank has given the limit of rupees 10 lakhs. Please look into this illustration. Bank has allowed you the limit of rupees 10 lakhs. Here the account may be either overdraft or cash credit. This illustration is applicable for both overdraft and cash credit. There is a minor difference between these two. I will explain after the end of the illustration. There is a minor difference between cash credit and overdraft, but let us look at how this account operates. Here the bank will give you the limit up to which you can access the bank funds. As per this illustration, State Bank of India has allowed company XXX overdraft of up to rupees 10 lakhs. The overdraft limit, or you can say cash credit limit, given by State Bank of India to company XXX is rupees 10 lakhs. That is the limit allowed by State Bank of India. If the firm XXX want to take 10 lakhs, they can take 10 lakhs, but if they do not want to take any money, they can still do not take any money. That means depending on the requirement, subject to the limit, the borrower will access the bank's funds and accordingly he will pay interest also. So if you look into this illustration, though the limit given is rupees 10 lakhs, the company has taken up to 4 lakhs only at one point of time, and subsequently they have taken 8 lakhs, subsequently they have taken 10 lakhs, subsequently they have taken 8.5 lakhs. Like that, depending on the requirement, the firm will access bank's funds, and as per the agreed terms and conditions, they will pay back. That means subject to the limit, company or the firm will access bank's funds. They will take some amount, pay back, take some amount, pay back. Like that, the chain goes on. It is otherwise known as revolving credit also, right? So if someone asks you the example of revolving credit, please don't forget cash credit is the example of revolving credit. This overdraft is example of revolving credit. Then credit card transaction is example of revolving credit. Credit card also, what will you do? You will purchase something and then you will pay back to the bank subject to the limit. Again you will purchase, you will pay back to the bank. So credit card transaction is also revolving credit. Like that, this overdraft facility, cash credit facility, these are examples of revolving credit. Bank limit will be fixed by the bank, and subject to the limit, you can access bank's funds and you will pay back as per the agreed terms of conditions. And here, from this illustration, it is very clear that cash credit, overdraft are the revolving accounts where you can access bank's funds subject to the limit, and you have to pay back subject to the agreed terms and conditions. Take the loan, pay back, take the loan, pay back. This is revolving credit. So these are the similarities of overdraft and cash credit. But there is a slight difference between this overdraft and cash credit. In overdraft and cash credit, the security which the lender will accept, that is the difference. In the case of cash credit account, the security is different in comparison to the overdraft account. In the cash credit account, normally the security is the goods or the produce. If somebody has brought raw materials to manufacture candles, they have manufactured candles or in the process of manufacturing candles. By taking the raw materials as collateral security, bank will allow you cash credit up to the limit. So here the collateral security is the produce or the raw materials or the finished product in your company or in your factory. Against the collateral security of your raw materials, or you can say against the hypothecation of this raw materials, you will be allowed up to certain limit to access bank funds by the bank, that is cash credit. Overdraft is also allowing up to certain limit, but the collateral securities may be different. Collateral security may be some share certificates, maybe some building, maybe some land site. Different type of collateral securities are accepted in overdraft account, whereas only the raw materials or produce is accepted as hypothecation in case of cash credit account, and barring this differentiation, both are one and the same except this differentiation, right? And there is a small difference between key cash credit account, open cash credit account. Key cash credit account is when the possession of goods, or you can say when the possession of raw materials is with the bank, then it is called key cash credit account, or when the possession of the raw materials are with the company, it is called open cash credit account. Then when it comes to overdraft, when overdraft is given without collateral security, sometimes overdraft is allowed without collateral security also. It depends on the relation of the customer with the bank. When the overdraft facility is allowed without collateral security, that is called clean overdraft facility, right? Let me summarize this cash credit account, this overdraft account. These are examples of revolving credit. Bank will give the limit up to which you can access the funds, and whenever you require, you can take and pay back, But the slight difference between these two is in the process of accepting the collateral security, right? So with this, you are familiar with cash credit account and overdraft account. Let us move on to fixed interest and floating interest. You are taking house loan for 20 years time period. When you take house loan, they will give you 10 years, 15 years, 20 years. Suppose let us assume you have taken house loan for 20 years time period, and during this period you have two options. Either to go for fixed interest rate or to go for floating interest rate. Fixed interest rate means the interest which will be decided at the time of granting loan, that will be constant throughout the loan period. There will not be any variation. Right? And in the floating interest rate, it will be floating. That means subject to the change in the base rate, your interest rate will be fixed. I am talking about floating interest rate. In floating interest rate, subject to the base rate, your interest rate will change. If the bank raises base rate, your interest rate will change, will increase. If the bank reduces base rate, your interest rate will come down. So the floating interest rate will depend on the base rate. If the bank increases base rate, your interest rate will increase. If the bank reduces base rate, your interest rate will reduce. So in the floating interest rate, your interest rate will be fixed at base rate plus certain percentage. In the fixed interest rate, it will be fixed. As in the fixed interest rate, the interest is fixed for the entire loan period in advance. No one knows what will happen to the economic situation in future. That's why normally the interest rates of fixed interest will be higher than the floating interest rates at the beginning. So when you opt for fixed interest rate, normally banks fix the interest rate at a slightly higher than the prevailing floating interest rate. Please don't forget. Right friends, look at the terminology associated with these loans. Please look into this illustration. Let us assume that the firm has taken home loan from State Bank of India. Right? After taking the home loan, the customer is required to pay back from the next month onwards. Customer, after taking the loan, EMI will be fixed. What is EMI? Equated monthly installment. That is to be paid back every month. Agriculture loans, there is exemption. Please don't forget, agriculture loans need not require to be paid back every month. All other loans normally are required to be paid back every month. After taking the loan, the customer has to pay back equated monthly installment that will be normally fixed from the next month onwards. He has to pay back to the bank. That is equated monthly installment. Second is spreading the payments over the total duration is known as amortization. The entire payment is to be spreaded over the entire period. Suppose the loan period is 120 months. You may be paying EMI every month fixed, but the EMI component will vary in principal and interest. EMI component will have two. One is the principal, the other one is interest. Both will vary, but if you combine together, that will be fixed, that is EMI, and the details of the payments, or you can say spreading the payments, indicating principal and interest over the entire loan period is known as amortization. Here the loan period is 120 months and spreading the payments over the multiple periods, or you can say over 120 months, that is amortization. Right? And the next one is the process of paying back EMI every month is called servicing of loan. The process of paying back loan every month is called servicing of loan. And if something happens, you have taken house loan, subsequently some earthquake occurred. You have taken house loan, immediately some earthquake occurs, then what will happen? You cannot pay, you may not be in a position to pay. Then under such circumstances, bank will give you some holiday, that is known as moratorium. The period which you are not required to pay back due to genuine reasons is moratorium. The amount to be paid every month is equated monthly installment. The process of paying back every month is servicing of loan. Spreading the amount throughout the loan period, indicating principal and interest, is amortization. I hope these terms are clear to you, and let us move on to what is EMI. EMI is equated monthly installment. It is fixed amount paid by the borrower to the lender on the specified date of every month. EMI is normally constant, and in the case of floating interest rates, just now I have told you, in the case of fixed interest rates, there is no problem. EMI will be constant, term will be constant. But in case of floating interest rates, no one can anticipate the interest rate. That's why interest rate may increase, may reduce depending on the base rate. Here also EMI will be constant, and the period may vary. If you have taken loan for 15 years, the period may become 14 years or 16 years, subject to the increase in base rate or reduction in the base rate. That means in floating interest rates, the interest rates will vary, due to which the period of the repayment may vary sometimes, because normally EMI is constant, right? Remaining things I have given here, and I have already told you the spreading the payment over the entire loan period. Spreading the payments over the entire loan period, indicating both interest and principal, is known as amortization, and indicating interest and principal, if the chart is given, that is amortization schedule, right? Please look into this. This is amortization schedule. That means every month EMI is 11,000 rupees as per this illustration. Every month EMI is 11,000 rupees, but out of 11,000, in the initial months, interest will be more and principal will be less. In the initial stages, interest will be more and principal will be less, and subsequently it will be reversed, right? So this is amortization schedule. Amortization schedule is nothing but the schedule spreading of payments over the entire loan period, indicating principal and interest is amortization schedule. Please don't forget. Let us look at lessor and lessee. The relation between lessor and lessee is landlord and tenant. Landlord and tenant. If someone is holding around 100 acres of land, someone is working as a tenant, the relation is lessor and lessee. Landlord is lessor, tenant is lessee, right? Landlord is lessor, tenant is lessee, and tenant will use the property of landlord, and for using that property, he will pay something to the landlord. In return, the lessee will pay some amount to the lessor. So please don't forget, this lessor or landlord is the rightful owner of the property, and by making payment, lessee will get the right to use it. And the lease agreement is for specified period. Lease agreement guaranteed the use of the property by the lessee, and in return lessor will get some amount from lessee for using that property. That is the meaning of lessor and lessee. And if some franchisee is using the brand name of company, then the relation is also lessor lessee. You know very well that at many places the companies will establish their franchisees, and franchisee will be lessee and the company will be lessor. For using the brand name, this franchisee will pay some royalty to the lessor or the company, right? Let us look at the bailor and the bailee relation. This is something different. In this case, possession of the property will be given, not the ownership. Possession of property. Just one example is the safe deposit lock. For keeping our utilities or for keeping our documents safely with the bank, we are hiring a safe deposit locker with the bank. And the customer is a bailor. Bank is bailee. Please don't forget, customer is the bailor. If customer is taking safe deposit locker, then customer is the bailer and bank is the bailee, and the process is called bailment. And please don't forget, bailment is the contractual transfer of a possession of asset but not the ownership. If I am keeping some documents in the safe deposit locker, I am allowing the bank to have the possession of the documents in safe custody and not the ownership. Ownership lies with the bailer. Ownership lies with the bailer. So, if some customer is taking some safe deposit locker, then the customer is the bailer, bank will be bailee, and as collateral security. And as collateral security, I am giving my share certificates to the bank, then I am the bailer, bank will be bailee. If I am giving some document to the bank as collateral security, then the customer is the bailer, bank will be the bailee, and the bailer-bailee relation, please look into it. Only the possession of the asset will be transferred with some specific objective. When I am using safe deposit locker, that means for ensuring safety of my document, for ensuring safety of my gold, I am keeping my properties within the safe deposit locker of the bank. That means I am giving the possession of that property to the bank, not the ownership. They cannot use the property. The process is called bailment. And let us now look at the next one, collateral security. Right? If bank is giving a loan without any collateral security, that is unsecured loan or signature loan. Normally, banks do not give unsecured loans. Bank will take something as collateral security. So here, collateral security is the fixed property or other asset which is offered by the borrower to the lender, which is offered by the borrower to the bank, that is the collateral security. So, here borrower will offer some property to the lender, that is the collateral security, right? Without collateral security, if you are getting loan, that is unsecured loan, right? Remaining points I have given here. When there is a security, interest rates will be less. Important point is, when there is a security such as house loans, mortgage loans, there is good security. That's why interest rate is less. But unsecured loans like personal loans, credit card advances, there the interest rates will be high because there is no collateral security. So, the fundamental point I would like to tell you is, when there is no collateral security, then interest rate will be high. When there is perfect collateral security, interest rate will be less. And this collateral can be offered in three ways. I would like to explain through this illustration. Right? The types of collateral can be pledge. What is pledge? Pledge is nothing but you are going to the bank, taking gold loan by keeping your ornaments with the bank, by keeping your share certificates with the bank. That is a pledge. By pledging your property with the bank authorities, you are taking loan. That is a pledge. Your gold will be with the bank. If you fail to repay, bank will sell that gold and they will get the money by selling the gold. So, pledge means your property will be with the bank. Second is mortgage. Mortgage means land or buildings, maybe house plot, maybe that building what you are seeing in this illustration can be offered as collateral security and then you can get loan. That is mortgage. Mortgage refers to land and buildings attached with land. Please don't forget. Land and buildings attached with land. So, that is the mortgage. Pledge means you are giving your property with the bank. You are keeping your gold with the bank. Mortgage is you are giving land or properties attached with land as collateral security for getting the loan. I would like to tell you 2 points here. Please look into this house, whatever is shown here. You have not offered that as a security to any bank, that property will be unencumbered property. You have not offered that to any bank as security, that property will be unencumbered property. But if you offer that as security to some bank, then it will become encumbered property. If you offer that property as security, then it will become encumbered property. And the other important point I would like to tell you, you have taken loan by giving this property as collateral security, giving this beautiful building as collateral security, and if you fail to pay back, then only bank will have right. That right is known as the lien over this property. That means they will have right. If you fail to pay back to the bank, then the right they will have will be lien over this property. That means lien over this property is LIEN. Lien over this property is the right which the bank will get when you fail to pay back the loan, right? So, unencumbered property, encumbered property, lien over this property, these terms please don't forget. Anyhow, let us come back. This mortgage is land or the structure attached with land. If you are giving them as security and taking loan, that is mortgage. Hypothecation. Hypothecation is you are producing some goods. You have brought several raw materials. And by keeping raw materials as security, if you are taking loan, that is hypothecation. You want to construct a rice mill. You want to hypothecate the machinery of the rice mill to the bank. That is hypothecation. That means by keeping the machinery as a security, you are getting loan from bank. And from the banker's point of view, this hypothecation is having more risk. Hypothecation has got more risk from banker's point of view because the borrower can do some mischief with this machinery and banks may not be able to get back the money if the borrower failed to pay back to the bank. The best security is pledge and the risky security is hypothecation, right? So this is the difference between pledge, mortgage and hypothecation. These three are collateral securities. Pledge, one example is gold loan. Mortgage loan is normally refers to mortgaging your land or buildings or commercial buildings. Then hypothecation is by giving your machinery, by giving your raw materials as collateral security to the bank. If you are getting loan, that is hypothecation. Normally all of you are well aware, in front of most of the rice mills, it is normally written hypothecated to State Bank of India or hypothecated to Bank of Baroda, like that. That means the machinery is hypothecated, the rice mill is hypothecated to the bank. Right friends, with this let us conclude the 10th module. Please do join for 11th module where we are going to discuss probably non-performing assets, then priority sector lending, and in the subsequent lectures we will discuss monetary policy of Reserve Bank of India. Have a nice day. Thank you.